It's Sunday, March 20th, 2022. This is all about your Benjamins and your weekly mixtape and week in review video. Hope you had a great week. As you can see down below, short on the topics to cover, some important ones, but not a lot to really cover. You can't see this right now, but it's Friday, and over there is March Madness. It's one of the best weekends, best Thursday, Friday, Saturday, Sundays of the year. Hope your bracket has not been busted, although Kentucky going out early on really hurt a lot of people, along with some of the other ones. And I'm sure since now, between Friday afternoon and Sunday when this goes up, there's been even more excitement in brackets being busted. So enjoy the games, and let's get to the headlines that may or may not be impacting your financial plan and portfolio. And we're going to start with the Fed. We talk about the Fed a lot, but they finally rose rates, which was not a surprise. They raised the rate by 0.25%, so a quarter of a point. And one of the things that investors were really wanting to see is what would the Fed say about the future. What are they planning on doing for the rest of the year? And they came out and said that the expectation or the goal is to raise rates 6 more times. Now, that may not be something that sounds like a good thing. Investors don't love to see rates going up because, again, rates going up has a negative impact in the short term on profitability. Borrowing costs go up. It costs more to borrow to go build. We know inflation is here. That's one of the reasons they want to be raising rates, is to try to fight inflation. But to hear 6, I think, is more than a lot of people expected. Now, just because they say the plan is to do 6, they may not. They leave themselves open to what's going on at that moment, to whether or not they continue to raise rates. I also don't know, and I don't study the Fed well enough to know if they are doing a little bit of over-promising and under-delivering, or under-promising and over-delivering in this case. So saying, hey, we're going to raise 6 knowing that they don't really plan to, so that if they come out and say we're going to hold rates as is, the market might like that, and it puts a little bit of a safety net underneath the market. I don't know. I don't know if their intent is to really raise it 6, or if they're just using that to put it out there so that if they do less, it is well received by the market. Now, that doesn't always guarantee that, though. So why would the Fed not raise rates or potentially even lower rates? I was on a Twitter Spaces at the beginning of the week, and we were talking about the Fed and what they might do. And one of the questions was, what would it surprise you in the Fed meeting this week? And my answer was if they cut rates. And the other advisor that was on there, he's an investment manager in the bond space. He said, we might actually be closer to them lowering rates than raising it too much. And he said if they lowered rates, that would be something that would really scare him, because they would be lowering rates if they felt that the economy overall could not stomach rising interest rates. The Fed doesn't make decisions because of the stock market. I do believe that they choose their words and they do let the market influence a little bit. But at the end of the day, they're looking at the overall economy. And if they were not going to lower rates to make the stock market happy. So if they lowered rates, that would mean that maybe the economy wasn't as strong as we believe it to be. So not saying that's going to be the case, but I also don't know if they really will raise all 6. And if they do raise it 6 times, maybe that means the economy is still doing well, or maybe that means inflation continued to ramp up and it really was necessary. But we'll have to wait and see. But they did raise rates quarter points, which means interest rates are going to start going up. I would imagine that the interest rate in your savings account will not go up as fast as it will in other places. The lending rates will go up much faster than what we earn in our savings. Kind of funny how that works. They come down real quick, but they go up real slow, and vice versa on the lending side. Speaking of lending side, the next article that you'll see talks about low interest rates on mortgages no longer being a thing. I think that talks about the era of the ultra low mortgage rate is over. That's a little bit of a clickbait, because even at 4.5%, that is still relatively and historically low for a 30-year mortgage, but it's not the 2.5% we saw a little over a year ago. One of the things that'll be interesting is the psychology behind this as rates go up, and we know they're going to keep going up. The Fed said they're going to raise 6 more times, which means rates will keep going up. Will this cause the housing market to heat up even more? And the reason I say that is people may feel like they've got to go out and buy now before rates keep on going up. If you want to have a fun exercise, run a mortgage calculator on prices of homes and just see how an interest rate makes a huge difference on how much home you can purchase. So if people are thinking about buying, or they want to buy and they know rates are going to go up, they can get more house for their dollar if interest rates are lower. We already know it's a competitive market. We already know people are paying over ask. They're paying cash for these houses now. Does this ramp it up a little bit more going into the rising interest rates? We'll see. I don't think you should make a decision to go rush out and buy a house just because of interest rates. There's a lot more that goes into it. I'm not saying you shouldn't, but I also don't think that should be the main deciding factor to get you off the sideline, because if other things in your financial picture are not where they need to be, then rushing out to lock in a low interest rate for a house that maybe is too much, or if other things you need to clean up first, may not be the best thing. Being in a better financial position in the future, even if interest rates are a little bit higher, might actually be better for you. Now, this is where the caveat comes in, or not the caveat, but the disclaimer comes in. Talk to your financial advisor to figure out whether or not you should try to take advantage of rates where they're at today versus where they'll be in the future, or if you have other areas in your financial picture that need to be cleaned up, and hopping into a house may not be the best thing for you. But it can be a conversation. I've already heard people talking about wanting to lock in interest rates. If you happen to have a high interest rate mortgage, looking at refinancing may be something to look at as well. Although I'd have to imagine that most of us who would have a higher interest rate have already refinanced in lower rates in the past, but maybe not. Maybe you got in a little while ago, credit wasn't where it needed to be, things have changed, and you could actually refinance to a lower rate. If you can refinance to a lower rate as rates go up, that might be a better thing for you to do, to lock in these lower rates today, in the anticipation of them going up in the future. That's it on the main areas of the big things on the market. The next one ties into inflation, and it is just talking about the current outbreak they're seeing over in China with COVID. So they're seeing numbers peak over there again, or spike, I guess, maybe not peak, but spike again, which has led to more people being sent home and things shutting down, manufacturing shutting down. And for a long time, we talked about the supply chain leading to what was believed to be transitory inflation. We're seeing that maybe it's not so transitory after all, but we're already at high inflation, and we are looking at potentially more shutdowns from manufacturing, which will only tighten the supply chain even more, potentially causing even more inflation in the short term. We'll see how long that lasts, but definitely something that is catching some of the headlines right now, with China having more COVID cases rising. So that'll be something to pay attention to. And then finally, totally unrelated to anything that is going to impact your plan or portfolio, but I found it to be interesting. Bob Iger, who is a former CEO and chair at Disney, is getting into the Metaverse. So I bring this up only because it's been a while since we've talked about crypto. Crypto hasn't gone anywhere, nor is it going to go anywhere. And I do believe it's going to become a bigger part of everyday business. To see somebody like Bob Iger, who has been a visionary when it came to Disney, what he came in and did with Disney and took it to the next level, getting into the Metaverse, investing in a Metaverse company that is helping celebrities build their brands on the Metaverse. So do you need to go out and run and try to invest in the Metaverse? No, but I just think it's interesting. He has a great track record when it comes to business. This is something we're seeing a lot of. We're seeing savvy investors, savvy business people going into Web3, going into crypto, going into Metaverse. Doesn't guarantee that that's going to be a successful space in the long run, but I also think it means you should pay attention to it and understand what's going on, and don't dismiss it just because it's not something you think you would use. You've got to think about future. Individuals like Bob Iger are thinking 10, 15, 20 years down the road. They're not thinking now. And he's looking at where the trends are going, where the demographics are going. More and more people are going to be looking at Metaverse type of situations and companies and environments. It makes sense to be in there. So just kind of interesting to see. And I also like the fact that he is in his 70s, I believe. I think maybe turned 70. He's older, yet he is investing in the Metaverse and staying up to date with everything going on. So again, not something that's going to make its way into your plan or portfolio in any ways. The other things do trickle into it a little bit, but just an interesting article that I found, and something to pay attention to when it comes to Metaverse. So that is it for today. It's a little bit shorter than last week. Skip over the recap of Pursuit and everything. But do check out this week's episode of Pursuit. You can head over to pursuit.co. That website is live now to check out all the episodes. But this week I talked about confidence. Next week we will have another episode of the next episode. If you didn't catch last week's, we talked about time management and happiness management with Terry in retirement and what that means to him. So that is up on the podcast. It's on YouTube as well. You can find those episodes on All About Your Benjamins. Be sure to check the mixtape down below. Go through the weekly review articles. Go through the money visual. Shout out to my friend Ashby Daniels who does those. Go through the tweet of the week. You will find the mixtape articles read through those and enjoy them. So with that, I will let you wrap up. It's Sunday. I am in Cincinnati. Leo has a soccer tournament. We should be heading home soon. I hope you had a great weekend. Hope the games are great, and we will see you all in the next episode.